Welcome to the 2024 Economic Depression and Preparation Channel. I'm your host, Tony. Thank you for joining me on this Monday edition, September 16, 2024 edition. Please be sure to subscribe to this channel for the latest interpretation of financial news as it becomes available. I appreciate all of you guys' support and comments. Thank you for this wonderful Preach to Me community. And today we're just going to be talking about the Federal Reserve Bank rate cuts that could be coming up. Some members of Congress have called for up to 75 basis point rate cut. Now, many economists expect that the Fed rate cut would be between 25 and 50 basis points. It's not uncommon that we will get an even higher rate cut than what's expected, given the fact that this is an election year and everything else that is transpiring on the U.S. front, and also what's happening with the European Central Bank. Stagflation is rising there, so they're cutting rates. Japan is cutting rates, and other banks around the world are cutting rates. So expect the U.S. Federal Reserve Bank to follow that schedule and maybe even take a more aggressive approach if the statistics warrant that, the job numbers and other numbers warrant that this coming Thursday. So it says this article was interesting. It said homeowners could save hundreds of dollars a month with the expected Federal Reserve interest rates cut. Now, ladies and gentlemen, you have to remember that even though the rate cut is coming down, the rates are still historically high, given that we were at 0% rates and helicopter money was flying everywhere before 2020 and, before 2008. Things were really going, accelerating very fast. Many people own 2 or 3 properties easily, either rental properties or, outside the country or otherwise, in different states and things of that nature. But now things have cooled down. And what they're saying is that homeowners could save because once they start cutting rates, some of the monthly mortgage payments will be getting lower in terms of the newer buyers. For those people who are looking to buy a new home or a new house in the next year or 2 or so, many experts, I will say, predict that the housing prices will come down a little more significantly, maybe not a lot, but maybe by 20-30% in most hot markets by 2026. So we're still another, a year and a half out from that. But in the short term, if they cut these rates 50 to 75 basis points as anticipated, that means that the mortgage payments will be coming down on some of the average balances that we've seen here today, this year. So in July, the national median mortgage payment was $21.40 a month. That's according to the Mortgage Bankers Association. So with each quarter point decrease in the 30-year fixed rate mortgage, borrowers could see that monthly payment fall by as much as $60, according to a report from mortgage data firm Intercontinental Exchange. Now, here's the problem. Mortgage rates, if they fall to 6% or below in the coming months, the average monthly payment may drop, but you have to factor in, of course, the taxes, insurance, and other fees, right? The homeowner association or condo association dues. So even though the monthly payment's coming down, if your property taxes are going up or if the insurance is going up because of where you're at, then obviously that negates the whole purpose. That just cancels the whole cheap mortgage payment, by $100 or more. But, that's some good news, is that this thing is coming down. They're done with the quantitative tightening. They're back to quantitative easing, quote unquote, which means, printing up more money, dropping the rates, and hoping that things will work out. I hope they don't break anything. That's what the Federal Reserve Bank is going to be doing. So average monthly rates, as you can see here, the 15-year was down to 5.27%. The 30-year fix is down to 6.2% as of this recording, as of September 24, by sources this from Freddie Mac's chart here. So if it falls down to 6% below after the cut, that would mean good news for housing, people looking for new housing. Now, rental market, that's case by case basis, depending on what city you're in. Obviously, there's not a lot of rental controls in a lot of these states. But the U.S. dollar hits more than 1-year low versus yen as the market eyes aggressive rate cut. So the dollar is hitting the low against the yen. And look, the U.S. dollar will continue to be devalued and purchasing power will be lost a lot in the United States. Now, outside the United States, the dollar is going to remain strong, maybe not versus the yen, but versus these other countries like Japan, England, Canada, Switzerland, and Swedish and all of that, because the fact that they hold a lot of our debt in dollars. And so the dollars is still huge amount of dollars are floating around in other countries. And so the dollar is going to see its advantage over those major currencies. As the other major currencies fall, the dollar is going to rise, and so there's strong purchasing power outside of the U.S. If you're in one of these countries and holding a lot of dollars, you're going to be at an advantage, at least in the short term, because the dollar is the least sickest child in the basket of currencies right now. So the dollar falls before the Fed meets. They made a note to fall by 0.34% according to the dollar index here. They made a note to point that out, this article by Reuters.com here. But don't be fooled. This is just in the short term, okay? Once the recession hits, the severe recession hurts, this is likely going to flip the other way in 2025. So don't be fooled by that, ladies and gentlemen. Now, White House's Brainerd, she says U.S. inflation is, quote, at a turning point. Focus is shift to jobs. So now she's saying, look, forget about the this National Economic Director, Larry L. Brainerd, doing the daily briefing at the White House. Is back in October 26, 2023. She says that, listen, we should not worry about inflation getting down to 2%. We should focus on jobs, because right now she understands that we're losing jobs in the tech sector, private sector, public sector. Every sector is losing jobs, bleeding jobs. We're only creating 140,000 jobs, and we have over 160 million eligible workers in the United States that are working. We have another 20 to 30 million that's going to be retiring in the next 5 to 10 years. And then we also have another 25 million that's underemployed. So we need to focus on jobs here. And that's what she's saying, to get rid of the 2% mandate about this inflation, below the inflation's 2% target and all that stuff. Because the real issue is going to be, if there's nobody working, nobody can afford these houses and nobody can afford these car loans. And credit is going to be dried up or seized up. The Dow Jones today was up 228 points today. It's surging ahead of the meeting. It's above 41,000. S&P 500 is surging as well. And all of that is looking good. The VIX index is still showing a little bit of volatility, but you have to remember also too that I believe the maximum the Dow Jones is going to reach is 50,000. Once it gets to 50,000, that's when the severe recession is going to hit, and all this is going to come tumbling down, starting with the credit market, the commercial market, and then goes down to the housing, car market, and then just regular on the street. That's when things get bad. So Dow Jones is going to continue to surge. This year's the year, always Grady, it's a war in 20s, but next year, about the middle of next year, say June, July, August, that's when things are going to get real, and people are going to realize, oh boy, there's no coming back. There's not much spending going on. And so you can see the Federal Reserve meeting schedule here. We're at the September 17th and 18th meeting, which is tomorrow. So Tuesday and Wednesday they meet. They'll come out with the policy meets there. Most economists, senior economists already have the notes. They'll be combing through the transcripts again to see if the Fed is hawkish or dovish or whatever the case may be. But the bottom line is that they'll widely anticipate to cut these rates down by at least 25 basis points, maybe 50 basis points if we're lucky. Congress has called for 75 basis points, but there's no guarantee that will happen, because they need to see some drastic changes in the stock market. And then we have 2 more meetings after that, November 6th and 7th and December 17th and 18th. Now, it is widely anticipated, ladies and gentlemen, that these next 2 meetings in November, December will also be cuts. It's possible that we get 2 cuts. Let's say we get a cut in September and a cut in November, right around or just before the elections or after the elections. I guess this will be. That would mean that the December one is up in the air. They can choose to leave rates unchanged if things start improving, or they can do a 50 basis rate cut in December to head us into New Year and the spur, of course, the Christmas and all of that stuff, to spur us into the Christmas season and tax season and all that stuff coming up in 2025. And that'll be kind of like the last hooray before next year, the rubber meets the road in the summer of next year, that's when they're going to let this thing start getting toward recession territory, and all of the magic tricks of terms of cutting rates and things, that the medicine's going to be wearing off, and that's what we really have to look forward to. So we have 3 more meetings left on this schedule. Like I said, the rate cut is for sure on September 18th tomorrow, September 17th tomorrow, and then November meeting they probably will cut again, maybe only 25 basis points, and in December they'll probably leave rates unchanged, and that's what's going to lead us into the recession after January next year, 2025, sort of a slowdown, as it always does. They're going to say the seasonal workers retire and all that stuff, and so we have to factor that in. So ladies and gentlemen, continue to prepare. Thank you for listening. Be sure to subscribe, hit that like button, and make sure you hit the like button so you make sure you get the notifications, because a lot of you guys may not be getting the notifications because YouTube is strange like that. But in any event, thank you for listening, and I look forward to seeing you in the next video. Thanks for rocking with me. God bless. I'll see you soon on the next video and talking about the Fed Reserve meeting, on that meeting when we get there. Thank you very much.